प्रेजेंटेड बाय ईबिक्स कैश। हर खुशी के लिए काफी है।
Hello and welcome. You're with us here on Business Today. I'm Abha Vakaya. Here are the headlines tonight. Bloodbath on D Street. Sensex down 1,100 points on Omicron fears. Nifty ends below 16,650. Realty, banking, metal shares worst hit. Ahead of budget, Prime Minister Modi meets leading CEOs across banking, infrastructure, automobiles, telecom sectors. Agenda to receive inputs and suggestions from the private sector. World Economic Forum postpones Davos meeting on COVID uncertainty. The annual meeting, which was set to take place between January 17th and 21, has been deferred to mid-2022. Weak market debut for Shriram Properties. Stock lists at 90 rupees with a discount of 24% compared to the issue price of 118 rupees per share. A bloodbath on the street today, with Indian stock market witnessing mayhem as key indices recorded the biggest single-day fall since April this year. All stocks in the Sensex turning red, with Bajaj Finance, IndusInd Bank, Tata Steel, SBI, NTPC, M&M and Bajaj Finserv being the biggest losers, down 4 to 6%. Heavy selling was seen across sectors, with nearly 9 lakh crore rupees of market cap being wiped out today. Fears of another massive COVID wave due to the Omicron variant, weakness in global markets, the beginning of a rate tightening cycle and year-end selling by foreign institutional investors are some of the key reasons for the biggest single-day fall since April in Indian stocks today. Sensex crashing 1,190 points, closing below 56,000. Nifty also down over 2%, barely holding on to 16,600. The indices had touched record highs just 2 months ago on the 19th of October. Since then, investors have lost nearly 25 lakh crore rupees from the peak market cap of 274.69 lakh crore rupees. While all sectoral indices were deep in the red, it was the Nifty Bank which hit a 5-month low after declining 3.3%. Heavy selling pressure was seen all across, with the Nifty Bank, Auto, Financial Services, Metal and Realty falling 4 to 6% in trade today. FMCG, IT and pharma stocks didn't fall as sharply, retreating between 1.4 to 2.6%. Global markets also witnessed sharp cuts, with Japan's Nikkei and Hong Kong's Hang Seng falling over 2% each. China's Shanghai Composite was down 1%, while South Korea's Kospi had also fallen 1.8% during trade. Our global business editor Udayan Mukherjee joining us now. Udayan, what a day for the markets. Never react well to uncertainty, and we can question whether or not this was a fall waiting to happen or whether the markets are genuinely spooked. What's your reading on the fall that we saw today?
We've seen this coming, Abha, and if you recall, last few weeks we've been discussing this very possibility that a combination of factors were coming together to trigger this correction. The market has been resilient. It could have fallen earlier, but every time it went below that 17,000 mark, it found a way to come back. But I think the straws have added over the last few days on the camel's back, and therefore it's becoming more difficult to fight against the constant exodus or selling that we're seeing from global investors. That's topped $3 billion already for the month of December, and it's becoming very difficult to neutralize by the domestic institutional investors. I think the reasons are well known, and we've been discussing them. One, of course, is that there is a global panic on Omicron right now. And while in India the cases have not ballooned, the kind of lockdowns and restrictions that we're seeing in all other major economies is probably prompting some kind of a global panic. The other, of course, is, and perhaps the more important reason now, is that people are waking up to the fact that the era of easy money that we've got used to is slowly coming to an end. There might be a difference in timing on when you expect it to start, but the tapering has begun and interest rate hikes will follow in 2022. And now it's quite clear to everyone that easy money is probably a thing of the past. And whenever that happens, valuations get cut back, because the link between liquidity and valuations is absolutely undeniable. So what I think is happening now is the market is figuring that liquidity will be less going forward, and therefore valuation expansions won't happen, and earnings will have to do the heavy lifting. So I think the combination of Omicron and interest rate hikes or easy money going away is leading to a lot of selling from FIIs, and that's the reason the market is correcting. I think it should surprise no one, because it has been some time coming.
So what happens to all those investors that just got in, Uday, and given the recent spate of issues and listings, given the recent non-stop record highs that we've been seeing on stock markets, not just in the last few months, but dips apart in the last 2 years, they've just consistently been performing. So what happens now? What should an investor do now?
I think a little bit of a reset is in order. It's not helpful for investors to panic and say, something has changed, we should sell everything. That never helps anybody. But I think a little bit of a reset has to be there, because money making had become too easy. As you described yourself, the market had seen only up moves and no down moves or corrections or pullbacks at all over the last year or so, more than a year. And I think now the terrain will change. More volatility happens, maybe longer stretches of stocks not returning anything. I think those kind of phases will come about once again. This is not to say that we are entering a vicious bear market. Far from it. I think at this stage there is no evidence to suggest that. But I think after such a strong performance, investors should prepare themselves for maybe a year of not very good returns. Well, the problem is everybody keeps talking about a correction, Abha, but when it happens, people start panicking. Nobody over the last few months has not spoken about the prospect of a correction. So it's happening right now. It should have been expected. And I think the right way to approach this is to say, don't rush into buying everything at the same time. Buy in a staggered way, because we don't know where the correction leads us. Sometimes corrections start somewhere and end somewhere else, as we have seen in the past. So buy in a staggered way and be prepared not to make money for 4 to 5 quarters. In the longer term, this may look like an opportunity, a long-awaited opportunity to buy those very good businesses that you've been waiting to buy. And don't try and get cute with that, the kind of stuff which fund managers talk about, that move money from one segment to another, buy companies which will protect your capital. Just buy the best businesses that you can find where valuations moderate. Don't care about what happens in 2022. Use this as a long-term opportunity, but there will be pain going forward.
Well, things are changing very fast, and to discuss some of the current factors at play, let's welcome in our market guru of the day, Uday, and we have one of our guests that we've known for a very long time joining us on the show today.
Basant Maheshwari, successful fund manager, founder of the Equity Desk, and also well-known author. Basant, good to have you on the show. It's quite a day to have you on because markets seem to have got into full-fledged correction mode. What's the sense you're getting? Is the correction about to deepen significantly from here?
Good to be with you then after a while. But on a very broad scale, this is not our bull market. Our bull figuratively is borrowed from NYSE. So when the Dow does well, we do well. When they do badly, we do badly. This is not our bull market. And because there are concerns in Europe and US, we are following with them. But if you ask me on a broader scale, I think the best is behind and the worst isn't too far away. So maybe we just hang around here, maybe 5, 7, 10% on the Nifty, but the best to me looks behind us. And I say this with some reason, because with every passing week, every passing quarter, every passing month, you would be nearing a phase of interest rate hikes. Whether they would do it or they would not do it is another issue, but the markets are always skeptical and they panic first, reasons come later.
So if an investor has a horizon of maybe a couple of years from now, say looking beyond 2022, what should one expect? Subpar returns, average returns, or capital erosion?
I think 2022 calendar year, if you can protect what you have made, maybe make 10% on that, I think it will be a great feat for you. But broadly, if you think that you would leave the markets and then come back in, markets never send us an invitation to join back. So if you leave the market, you're left out. So you have to be here. You have to take the pain. It's like what they say, "Jeena yahan, marna yahan." You leave the market, you're left out. So you have to be here, even though you know that the returns would be not so great.
And would you distinguish between large caps and mid caps? Because when a correction is looming, a lot of people switch to the safety of quite expensive large caps. Do you see 2022 being a year like that, where mid caps underperform large caps, or you don't think that necessarily follows?
For the moment, everything is falling because the foreigners have sold 80,000 crore worth of stock. So, but broadly, the foreigners cannot keep selling till eternity. They would stop at a point. And then the buying shifts back to large caps. The initial phase of a bull run is led by large caps. The mid caps join the party later on. But I think it's the time to be with larger players, then try and look for the gems in the dust kind of a theme, because it is very, very difficult for people to do well when the broad market itself is not in a roaring bull phase. So it's better to be with large caps right now, with dominant industry players dominating the industry, rather than go and look for the small cap and mid cap themes right now.
Basant, you've been fairly positive about the economic cycle and how we're poised, at least with regards to domestic factors, at the cusp of a new growth phase. Does that scenario remain intact? Do you feel that global headwinds apart, the domestic story can still play out?
No, I have a different view, Abha.
Okay.
I think domestically there are headwinds.
Okay.
Globally, we are still floating because there's so much of liquidity and we're doing well. So what is doing well? I keep saying this all the time. The global auto companies are doing well. The global metals are doing well. The IT is in another phase. The pharmas did well in the initial phase. What isn't doing well? Banking, financials. And they are the core of India. So these banks, 99% of their operations, maybe 100% of them come from India, and they are not doing well. So basically, there's some problem with the domestic economy. Internationally, because there's so much money chasing stocks, those companies are doing well.
That's an interesting point, Basant, because there is so much heartburn about the fact that the bank nifty is not doing well, and the common perception seems to be banks are not doing well because FIIs own them and FIIs is selling, and therefore HDFC Bank and HDFC and ICICI cannot do well. But you're saying that it's not just a technical factor, that there is a fundamental reason for it, for why banks are underperforming the market.
Udayan, FIs also own the IT stocks. They own Infosys, they own TCS, they own the HCL Techs, the Mindtrees, the Coforge, and everything. But those stocks, year to date, they have delivered. So it's good to see. We did this study. So when the FIs start to sell, everything falls. But after 1 month, after 2 months, it's like things finding their own level. So the water finds its own level. The good stocks come back. So banks, I think they're in some sort of a bother. They've gone up because there was so much of money floating around. Kotak Bank, I think year to date hasn't given positive return. It could be 1 or 2% here and there. And Kotak is one of the pristine banks in India. So there is something wrong which is happening. So maybe, I don't know what's there. Maybe the COVID, the lockdowns, the overarching fear of nothing big happening right now on the domestic front. But whatever it is, I think the bank nifty and the financials are in a problem.
You also mentioned the global commodity cycle. There, people made a lot of money through 2021, but the last few weeks has been quite brutal for even metal stocks. I mean, names like Tata Steel have corrected by 300-400 rupees. Do you think the commodity cycle is over, or would you use this as an opportunity to own stocks like Tata Steel?
So if internet and digital is defined by what happens in America, I think metals like steel and aluminum is determined or defined by what happens in China. So there are two schools of thought. The first school of thought is to assume that China is going to grow at sub 5% next year. Then there's a huge problem everywhere. The second school of thought is China wouldn't grow at sub 5. They would grow at 6, 7, 8%. They would need to reflate their economy. And that China is playing a great trick. They are cutting down interest rates. America and Europe are increasing interest rates. So I think the balance of trade is shifting towards China. I think China is the only player on the chessboard who can go and tell Powell that, wait, hang on a minute, you cannot raise rates. So I think China growth would come back. And importantly, as long as China doesn't export metals, we are all fine. All the previous last 2 decades, if you go around, all the metal hammering has come across because China was exporting deflation across the globe. So if China is not exporting, and they're not exporting because of climate reasons, and they've removed their export incentives to metals for like steel and aluminum also. So I think we are all fine. But for the moment, when things fall, everything falls.
All right. Which are the other parts of the market, Basant, that you would say avoid? Because that's also what an investor should know right now, given that, we have seen markets correct at the start of the week. Would you suggest, in your past interviews, I know you've sometimes talked about even the new age stocks, for instance, tech, anything else on that list, perhaps, that would be a clear avoid right now?
Yeah, I would avoid a company that's trading FY24 500 times PE. So we've known to be buying high PE stocks, but high also has got a level. You can't buy a stock whose PE is at 500 FY24. So for a company like Zomato, great business. So what's the problem in Zomato? There's no problem as long as you get fresh funding. If there is a bear market, you can't do a QIP. If you can't do a QIP, who gives you money to burn? Nobody. So that's a problem. These are not recommendations actually, but it's just a representative of what we think actually. So these are stocks where you need fresh funding. So even if you don't need fresh funding and your stock is trading 500x FY24, as bad as anything. So you wouldn't want to be caught in that kind of a whirlpool for that matter. So these are stocks which look good. You got a listing in, you made money, go home, enjoy.
You can catch that entire exclusive conversation with Basant Maheshwari on businesstoday.in as well as on our YouTube channel. Now, the World Economic Forum has deferred its annual meeting in Davos, Switzerland, in light of continued uncertainty over the Omicron outbreak. The annual meeting was scheduled to take place between the 17th and 21st of January 2022. It's now planned for early summer. The forum said that the current pandemic conditions make it extremely difficult to deliver a global in-person meeting. Despite the meeting's stringent health protocols, the transmissibility of Omicron and its impact on travel and mobility have made deferral necessary. Today, Lok Sabha cleared the second batch of supplementary demands for grants. This has authorized the government to spend an additional 3.73 lakh crore rupees during the current fiscal. Finance Minister Nirmala Sitharaman replied to the opposition in Lok Sabha, stating that extra spending would be used over a range of things. Few of these include infusing 62,000 crore rupees into residual assets and liabilities of Air India, 58,430 crore rupees by way of additional fertilizer subsidy, 53,123 crore rupees towards payment of pending export incentives, 22,039 crore rupees to Rural Development Ministry for transfer to National Rural Employment Guarantee Fund. Sitharaman also assured to moderate prices of edible oil and other essential items. Let's listen in to the Finance Minister.
Whereas in 21-22, we are given the consideration that second wave and also extending the food subsidy, and also by the reduction in the fuel price which the central government has brought in, our revenues have come down to that extent, and also the fertilizer subsidy which I just mentioned, our additional demand put together is 9.3% in 21-22 BE, whilst in the excluding railways in the BE, therefore it's about 9.6. That is regarding the supplementary demand itself.
While the market suffered one of the worst crashes in months, shares of Future Retail rallied in trade today. The stock was up 20% after CCI on Friday suspended Amazon's 2019 deal with Future Retail. The antitrust watchdog imposed 200 crore rupee penalty on Amazon and said that e-commerce major had deliberately suppressed information about the scope and purpose of the deal. The shares of Future Group companies across the board jumped after reports suggested that the company is likely to approach various courts and tribunal, asking them to terminate all pending cases related to the sale of its retail assets to Reliance Retail in the wake of the CCI order. South-based real estate developer Shriram Properties made a weak debut on the bourses today as the stock listed at 90 rupees with a discount of 24% compared to the issue price of 118 rupees per share. Although the realty company had seen a good response from investors as the offer was subscribed 4.6 times. Shriram Properties is a part of the Shriram Group and is one of the leading residential real estate development companies in South India. It primarily focuses on the mid-market and affordable housing segment. One of the country's leading cash management companies, CMS Info Systems, will launch its initial public offering tomorrow. The company plans to raise 1,100 crore rupees through its public issue. The price band has been fixed at 205 to 216 rupees per share. The issue is complete offer for sale by Sion Investment Holdings, which holds 100% of the company. The company has reserved 35% of its issue for retail investors and 50% for qualified institutional buyers. The IPO can be of interest for investors considering a reasonable valuation. Being profitable and having no long-term debt may also help bring investors to the issue. Here's what else is making news in the corporate world. Blinkit, formerly known as Grofers, will close down delivery in areas where it can't deliver in 10 minutes. The company has estimated that this business decision will impact 75,000 of its 200,000 daily customers. Customers can update their exact location on the Blinkit app to find out if they will continue to be served. Adani Transmission has completed a 897 circuit kilometer interstate transmission line comprising 765 kilovolt and 400 kilovolt in UP. This is one of India's largest intrastate transmission lines. With this, Adani Transmission's operational and under construction assets add up to more than 18,300 circuit kilometers. Equitas Small Finance Bank has been impanelled as a banking partner by the government of Maharashtra. The agreement will entitle Equitas Small Finance Bank to distribute salaries and allowances to state government employees as well as make provision of pension to pensioners. And that's all we could pack into the show today. Thanks so much for watching.